Gentlemen, good day and welcome to the Max Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare Q3 and 9M FY23 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good morning to everyone. I am pleased to welcome you to Max Healthcare's Q3 earnings call. Our performance for this quarter was on expected lines and reflected continued focus on execution by the hospital teams while maintaining high levels of medical quality and patient satisfaction. Compared to Q3 last year, the occupancies, revenues, EBITDA, and other operating and financial parameters have improved considerably. While compared to Q2, this quarter expectedly witnessed a slight dip in the occupancies due to festive season, and revenue was relatively flat. However, we yet again reported our highest ever EBITDA, both in terms of absolute value and margins. EBITDA per bed, ARPOB, and ROCE for the third consecutive quarter this financial year. Our digital app, Max My Health, which was soft launched at the end of September 2022, has already witnessed approximately 90,000 downloads. The app is now ready for a formal launch in the fourth quarter of the current year. Before I move on to the highlights of this quarter, please note that comparative numbers and percentages are being reported on a like-to-like basis, excluding COVID-19 vaccinations and one-time tax gain in the previous quarter. Key highlights of our third quarter performance are: occupancy for the quarter improved to 77% from 74% in Q3 last year. However, it was marginally lower than 78% for the previous quarter due to festival season. Institutional bed share fell to 29% compared to 31% in Q3 last year. The bed share was 1% higher than the previous quarter due to relaxation owing to lower occupancy in festive season. Network gross revenue was 1,559 crores compared to 1,385 crores in Q3 last year and 1,567 crores in the previous quarter. This reflects a growth of 13% year-on-year while remaining flat quarter-on-quarter due to seasonality. Revenue from international patients grew by 62% year-on-year and reflected 110% of pre-COVID average. This accounts for around 9% of the revenues now. Digital revenue grew to 272 crores and accounted for 17% of overall revenue. ARPOB for the quarter rose to approximately 66,800, reflecting a growth of 10% year-on-year and 1% quarter-on-quarter. We reported our highest ever network operating EBITDA of 419 crore rupees compared to 364 crores in Q3 last year and 410 crores in the previous quarter, reflecting a growth of 15% year-on-year and 2% quarter-on-quarter. We are actively managing the costs and there is a reduction in overheads quarter-on-quarter due to better collections in power costs. Operating EBITDA margin improved to 28.3% versus 27.8% in Q3 last year and 27.7% in the previous quarter. Annualized EBITDA per bed, most importantly, rose to 66.9 lakhs, yet again our highest ever, clocking a growth of 12% year-on-year and 4% quarter-on-quarter. Profit after tax was 269 crores versus 252 crores in Q3 last year and 267 crores in the previous quarter. Net cash position stood at 372 crores at the end of December 2022 compared to net debt of 296 crores last year. This is after deployment of 102 crore towards the ongoing capacity expansion projects. Continuing our efforts to give back to the community, we treated 38,344 OPD and 1,264 IPD patients from economically weaker sections free of charge. In addition, we provided nutritional support to around 2,300 TB patients during the quarter. Both our SBUs continue to report robust numbers. Max at Home reported a top line of 36 crores, reflecting a growth of 30% year-on-year and 4% quarter-on-quarter. It started immunization at home services and now has 14 service line offerings. Max Lab reported a gross revenue of 28 crores. This reflects a growth of 46% year-on-year while declining by 4% quarter-on-quarter due to seasonality. The active network partners stood at over 900, spread across 34 cities and supported by a dedicated team of more than 700 personnel. Now coming to the overview of the company's financial performance for the 9 months ended December 31, 2022. Network gross revenue stood at 4,597 crores, reflecting a growth of 16% on a like-to-like basis. Network operating EBITDA stood at 1,199 crores, registering a growth of 20% on a like-to-like basis. ARPOB improved by 16% due to price, payer mix, case mix, etc., and led to margin expansion by 92 basis points. EBITDA per bed grew by 21% to 64.4 lakhs. COVID-19 bed occupancy was negligible throughout. On average, COVID-19 patients occupied merely 5 beds in Q3 and 20 beds during the 9 months. On expansion projects, the current status of capacity coming on stream by FY23 is as follows. 100 beds at Shalimar Bagh have been more or less handed over to operations team, and we are on schedule for starting the operations in the current quarter. 300 beds at Dwarka, the structure is complete and interior work is underway. We plan to file for occupancy certificate by May and operationalize in Q2 FY24 as planned. 329 beds at Nanavati. The contract has been awarded to Larsen & Toubro on a turnkey basis in December for handing over the hospital over 24 months. L&T is fully mobilized and we expect to commission the facility by end of FY25. 300 beds at Sector 56 Gurgaon. Work has commenced. Excavation, and this 300 beds is the first phase. Work has commenced. Excavation and de-wall work will be completed by first quarter FY24, by which time the civil contractor will also be mobilized. We would also like to point out that Sector 53 land cancellation has no impact on our bed addition plan till FY28. It wasn't part of an expansion rollout, but will, if at all, impact bed potential post FY 2028 as we had put down in investor presentation. So, all in all, up till this stage, we are seeing no delays. We are focused on execution and it is going to be on spot as planned. 350 beds at Max Smart. The project is delayed by around 3 months for lack of final tree cutting permission, which has been received in January this year now. The work will start in the current quarter and we hope to recoup the time lost as we progress on the project. While we continue our focus on the growth levers articulated in the past, we have also been evaluating avenues for catering to demand for quality healthcare in the near term. We expect to add over 100 beds in the next 2 quarters at some of our hospitals through internal reconfigurations. Moreover, with our net cash surplus and deleveraged balance sheet, we are extremely well positioned and actively evaluating inorganic growth opportunities. As of yesterday, our board has given in-principle approval to raise finance of up to 4,200 crores of NCDs for any future M&A. However, we intend not to breach 2 to 2.5 times net debt to EBITDA, considering that any new acquisition will also bring its own EBITDA in play. With this, we open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi. Good morning, sir. My first question was to be on net debt to EBITDA. I think you have kind of cleared it. But just at a slightly higher level, I wanted to understand, with so much of organic bed expansions planned over the next 4-5 years, is there a pressing need to do an M&A, or whatever M&A that you are seeking is going to be very, very valuation conscious, and there has to be some clear rationale for you to be looking for an M&A? Because I believe the bed capex plans itself, they kind of take care of the medium to long-term growth of the company.
No, I think, we're not putting a cap on the long-term growth. I think, if you look at the opportunity set which is out there, it is significantly higher than what we are looking to tap through our brownfields or whatever we're expanding. One is that. I think secondly, also, given the fact that we have a completely unlevered balance sheet, we've got more than 1,000 crores of cash sitting, we've got a net debt position of some 360, 370 crores. Our entire expansion, which is at a cost of about 4 to 4,500 crores over the next 4 years, okay, is going to be conducted entirely through about 50% of our free cash flows. So we have a totally unlevered balance sheet, and we have the rest of our free cash flows to deploy. And given the opportunity set out there, and again, if you've seen our history, it's been about buying assets at values which are intrinsically below what we believe we can ilk out over there in EBITDA. Okay, so these will all be massively value accretive. We are very, very conscious of ROC. We are already operating at very, very high ROCs, like I've said before, also in my past calls. So I think anything that we will be acquiring is going to be accretive. We are not acquiring for the sake of it.
Understood. And sir, what are the priorities in terms of?
One more, this thing also gives us, it also gives us presence in newer geographies. Understood.
And in terms of regional priorities, I think North looks pretty sorted for the company. There is obviously media article of you venturing out in Kolkata, looking out for something there. But would it be safe to assume that, I mean, my understanding, perhaps the southern markets is a bit more competitive, so you might be looking more for west and east. Would that be fair?
Well, not really. I think, if you look at, I've gone in the past and said, look, we won't go to uncharted territory. I will go to any territory where at least 2 or 3 of my competitors have proven viability, and we will do it better, like we pretty much have done without exception every micro market that we present in. If you go by that list, I think the number of cities will be in the 20s or mid-20s, where number of people have proven viability. I mean, we do operate a hospital in Mumbai, which is Western India. It's the only asset that we have and it operates pretty well. And if we look at what we are doing in even outside the cluster, early NCR, in places, tier 2 cities like Mohali or Dehradun, which are extremely high ROC businesses for us. So I think, even entry into the southern markets, when you look at what their profitability, etc., are, I think, so long as we have conviction that we can ilk out and we can make it accretive, it becomes a sensible entry point for us.
Got it. One more question I had on the operations for this particular year. Now, I think the investor presentation gives a number of a clinical update on liver transplants, kidney transplants, and bone marrow transplants done till date. But can you give some sense as to what is the number for these three categories of transplants looking like in FY23? And what growth are we envisaging in the number of transplants that we will be doing in the coming 2-3 years? Because I mean, the clear question here is that these initiatives are ARPOB accretive, so that could be the ARPOB driver for you in the coming 2-3 years.
But it doesn't really move the needle. I mean, you have to look at it collectively. I think overall this transplant business is 5-6% of our.
Yeah, so Nikhil, basically, if you come to the liver transplant, we do around 40 to 45 of them every month, right? And kidney transplant will be again a bit higher than that. It will be around 60-65 every month. So I think, and BMT would be another 25 to 30. So these are the ranges that we have. Obviously, the endeavor of the hospital is to start this program in more and more hospitals. For example, that's what we did in liver transplant. We started a program in Vaishali, we started the program in BLT, we are starting the program in Mohali and in Dehradun now. So, and we are waiting for the license. So what I'm saying is, obviously, that's always the effort, right? So now to put a number in, projected number, and that's very tough for us, right? We can't really, there's no order book that we have, right?
But moreover, what I'm saying is, look, this is going to be incremental. Because there's already a particular pace at which we add, so this is going to be incremental. You're not going to see an exponential move because there's, even if I double this number, you're not going to see an exponential change in EBITDA or margins because of which.
All right. Got it, sir. Thank you so much.
Thank you. The next question is from the line of Damayanti Karai from HSBC. Please go ahead.
Hi, good morning. First, one clarification. Abhay, did you mention you would be able to add another 100 beds through internal reconfiguration apart from the planned ongoing capex?
But I said over 100 beds. So it's a number which is higher than 100 beds, yeah.
Okay, that's clear. So,
yes. So through internal reconfigurations, okay, we will be adding this and we'll be adding this over the next few months.
Next few months, okay. My second question is, how do you see your operating costs inching up as your planned beds come online over next 2-3 years, both on the variable as well as fixed cost part?
I think, majority of the capex that we're doing or the rollout we're doing is towards brownfields, right? I mean, 80-85% of the total rollout is towards brownfields, and brownfields by their very virtue have higher operating leverage. So, because it doesn't necessarily have a fixed cost associated to it, because the fixed cost, be it in terms of management or senior clinicians, etc., is already incurred by the existing hospitals. So when you add another tower next to it, it has lower sort of, or doesn't have that, so you technically have a higher operating leverage. So your operating cost overall should come down.
Okay, because you would be able to expand the existing resources to a higher number of beds, right? So that's why.
That's right. And what you are actually putting over there are nurses or resident doctors, etc. Your senior clinicians already in play. And the reason you're doing these brownfields in the first place is because you're capacitied out, right? I mean, you've got unsatiated demand at your doorstep. Your doctors have no, they don't get OT time, they don't get beds for their patients, and so on and so forth.
Okay, and in most of these brownfield expansion, should we assume the break-even should be achievable within 12 to 15 months of the commencement of the unit?
No, I've stated in the past, the brownfield should have a break-even in the first quarter or two, if not the first quarter itself.
Okay, so within 2 quarters, we can reasonably assume that
Absolutely.
Okay.
So in a brownfield, you not open the bed till such time you are able to fill it, right? So there's no need for us to open all the beds.
Okay, understood.
No, I mean, not that we don't have the need, we have the need. I think the point which Yogesh is making, also you're holding the asset on your books, right? But there's no real fixed cost associated to it from an operating standpoint.
Okay. And my last question is, can you talk a bit about your ESOP programs? And right now, what percentage of Max employees are covered by your ESOPs? And what kind of annual expense you expect for the stock option programs?
So I think there are about
81 lakh shares, 271 employees.
271 employees, okay, are covered by the ESOP plan. I think the important thing is that the cliff for the ESOP plan, okay, is
20%.
Is 20% IRR,
At which is,
and which comes to a price of, I think,
I think to vest the 100% of the ESOP, the price is 1260 after 5 years.
so there's a cliff. If it doesn't hit that price, the ESOPs don't sort of 100%.
CAGR.
That's right.
Sorry, I just missed the price. Sorry, 1,000.
Damayanti, basically the ESOP has a clause. So there are two portions to ESOP. So one is what is the individual performance, other is the company performance. So the company performance part, which is a large part mainly for the leadership team, basically will vest after 5 years, provided there is a 25% CAGR in the share price when we do ESOPs. So at that point, at that rate, the price required for 100% of these to vest is 1260 rupees at the end of 5 years.
Okay. Okay. Understood. Understood. Thank you. I'll get back in the queue.
Thank you. The next question is from the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Yeah, hi sir. Am I audible, sir?
Yeah.
Yeah. So my first question is that can you dwell a little bit more on how the international patient pace is moving, how the things look forward. For example, in one of the line you mentioned that the sales are already at 10% higher than
Amit,
the.
may I request you to use the handset, please?
Okay, I'll do that. Okay, is this fine now? Is this
It's
better?
a little low. Can you speak up a bit?
Okay. Is this okay?
Yes. Yes.
Okay.
Yeah, better.
Yeah. So I just can you dwell a little bit on the international patient, how that particular mix or segment is moving? In one of the presentation, in one of the slide, you mentioned that the sales are already at 10% higher than the pre-COVID. Just wanted to know that on the footfall, how the things are looking, where the traction is coming. How do I see the year going forward? Because last time when we spoke, you had mentioned about Afghanistan not present, but you are trying to cope up that particular thing with some other geography. Just maybe 2-3 minutes brief on that particular segment, please.
We're not trying to cope up. We have coped up, right? So in spite of the Afghanistan, which was 12% of our business down to zero, we are 110% of pre-COVID levels. So what that basically implies is that not have we coped up with lack of Afghanistan, but we've sort of overcompensated for it, right? So that's one. Secondly, I mean, to have a discussion on present footfalls, you'll have to have a point of reference from past footfalls. I mean, the fact that this number has been moving up, we're getting massive traction on this. It's over 60% compared to last year. It's over 110% compared to pre-COVID levels, in spite of 12% of Afghanistan business not being there. Hopefully in the next quarter or 2 quarters, depending on the geopolitics, as and when Afghanistan does open, this will give us further this thing. But in the meantime, we'll be looking at other geographies as well. We've been opening offices in other places. And we are going to be looking at more direct to, I guess with also the support of the Indian government through Heal in India and Heal by India, there is focus on global medical tourism. So I think we can have a step change over here. I haven't given any guidances in terms of footfalls in future or revenue guidance in terms of, in terms of international patient or any other sort of revenue guidance. So I'm going to avoid that even at this stage.
So when we say it's like a revenue is at 10% higher, then even the footfalls are, I assume that if realization being same, then those even footfalls are higher than the pre-COVID?
Yes, more or less, yes. But may not be 10%, maybe probably 4 to 5%.
Okay, got it. Second is, Yogesh sir, you can help me with this thing. In one of the presentation footnote, you have mentioned that there was a recovery in terms of bad debts, which you have under that overheads. So can you just help me with that particular number, please?
So that number would be around 7 crores.
Okay.
During the quarter. Right, but this is a charge of this happened. So this is charged during the quarter. So this is obviously it's a running system that we have. So at the end of each quarter, whatever bill is above 5 days, they will get provision for, right?
So we have a very stringent policy that anything which is over 365 days, okay, we provide for.
Right, because you had mentioned that why the things that OPEX is sequentially down. One of the line item you mentioned that one of this is the reason.
Yeah, we did mention, yes.
Okay.
That's right. Yeah. So there's impact, and there's always be impact. This obviously depends on when the election comes. So some we have around 16-70% of business which is PSU revenue share, and the payments from CGHS are tardy. They come in blocks.
Okay.
Sometimes they come over 365 days, then we write it off at the end of 365 days, provide for it, and then when it comes back, we have to write it back.
Okay. Yeah. And just like want to know further, like because you had said that another 100 is are expecting in next few months through the internal reconfiguration. Is it across the various hospitals or is it from one particular thing? Second is that is it safe to build this particular increase in terms of like somewhere in Q1 or Q2 of FY24?
Yeah, so I mean, it should come in through by Q1, Q2 of FY24, right?
Yeah, it's in
these are in 3 or 4 or 5 separate hospitals. So it'll be 20 beds somewhere, there were 30 beds somewhere, and so on. So collectively it's over 100 beds, and clearly you elk out this capacity in places where you're hitting thresholds. When you get to that stage, you find elasticity, you find reconfiguration, and so on to be able to get. You don't do it in a place where you already have even little bit of leeway as far as idle capacity is concerned. So you have to understand, as we are coming close to threshold capacities in place, or what we earlier thought were threshold capacities, both in terms of operations and number of beds, we find there is elasticity at the end, right? Once you get, it's like manufacturing process. Your rated capacity may be 75%. When you come to the 75%, you realize that you can operate 80%. When you get to 80%, you realize you can get to 80 to 83%, and so on.
Right. Yeah. So that's it. I'll fall back in queue. Thank you.
Thank you.
Thank you. The next question is in the line of Naman Bhansali from Perpetuity Ventures. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question relates to the international patients, and I think it's around 8.5% contribution. But if we want to view it as a percentage of only Delhi hospitals, so how much would that percentage be? And relating to the international patients, like what is the structure that we follow to attract these international patients? Like, do we pay some medical consultancy fees to any agencies, or what sort of cost do we pay to attract these patients, and how is it versus the industry and max? So this is my first question, and my second question relates to the margin structure of brownfield expansion which we are doing. So with every incremental bed additions, how do we see the incremental margins which we get on the brownfield beds? And lastly, on the RPOP difference, like what is the difference majorly in our business between the international and domestic RPOP, and how would it boil down in terms of EBITDA per bed? So these are my questions.
Let me start by margin on brownfields and come to. So as far as margin on brownfields are concerned, our typical brownfield will cost us about 130, 140 lakhs per bed. Our present EBITDA per bed is about 66 lakhs last quarter. If you apply even a 75% occupancy rate to it, so that comes to about 66 lakhs, it will be about 45-50 lakhs, I presume. So you're looking at 50 lakhs on top of 130. This is if you were doing business as usual. But like I've mentioned, there is operating leverage in brownfield, so EBITDA per bed should be northwards of that. And more importantly, over the next couple of years, by the time all of this comes on stream, you'll have some real and inflationary growth on top line as well. So it is massively accretive. Look, the most attractive thing you'll ever do, okay, more than M&A, more than greenfield, etc., is brownfields. Okay, because A, you're building in a proven area where you are tapping into unsatiated demand, and then you have huge amount of operating leverage coming out. So that is exactly what we are doing. So that's one. I hope that answers your question as far as margins are concerned. Now, coming to your...
so on the RPOP question that you asked, on the international side, typically the ARR, the ticket size for the international patient is double of the domestic because of the fact that there are more acute patients, but the LOS is also higher, right? So the average length of stay of this patient is also 1.3 times of the normal. So typically that means that the RPOP will be 1.5 times of the domestic patients. When I say domestic patients, they'll be cash domestic patients, right? So that's the on the ARPOB. Yes, the EBITDA per bed is higher because of the fact that these are higher ARPOB. So even if you maintain the same margin percentage, after payout to these, HCF, the facilitators, your EBITDA per bed would be again, around 20% higher than the domestic patients.
But having said that, we get our marketing is done through multiple channels. There are, at the very least, there are walk-in patients where there are no facilitators involved. Then you have patients and people who come through our digital platform, come through our offices overseas, and so on and so forth. Then you have patients who come through international medical tourism companies. In those situations, we make a payment of facilitation fees to those international medical tourism companies. The third is we have tie-ups with various ministries of health in various countries. We have tie-ups in hospitals. At any given point of time, number of our doctors are traveling overseas, conducting OPD screenings. So it's a fairly organic process. We also have doctors from these countries who come to our hospitals and work as observers. They go back, they champion this thing. But we conduct OPDs, we screen the patients, we do pre-consult, post-consults over there, and so on. And that's how that's the backbone of how you do medical tourism.
Yeah. Also on your question, about the share of international patients in the NCR hospitals or Delhi hospitals. So it range from 18 to 4%, right? So the maximum is in BLK hospital, BLK Max hospital, and then followed with Saket, and then you have other hospitals like Vaishali and Patparganj, etc. So on an average, it'll be probably 11 to 12% in the NCR hospitals.
Okay, got it. And what is the maximum on a consolidated basis? Like we are currently at 8.5% international contribution, and this can go up to what, 10-11%?
I mean, it depends how much we are doing, right? Like I said, I'm going to avoid giving any sort of guidance in terms of how much of this business we are going to be shooting for over the next 4 to 5 years. But like I said, the potential is exponential, not incremental.
Okay, sure. Thank you for the answer. That's all.
Thank you.
Thank you. The next question is from the line of Ashish Tavkar from IIFL AMC. Please go ahead.
Yeah, thanks for the opportunity. Sir, if you could spell out, is there a certain seasonality in our business? Because if we try to have a look at the occupancy rates, quarter 4 seems to be much lower than the earlier quarters. So if you could just help us understand the nature of the business.
Absolutely. So there is a seasonality in the business. So even if you go back to our last quarter's investor call or the presentation, when we had the higher occupancy, we said in Q2 that the occupancy is higher because of seasonality, right? In the rainy season, you have diseases, airborne diseases, etc. So in Q2, typically all hospitals have higher occupancies, right? I mean, this is, like I mentioned, due to the seasonality and the flu season and so on and so forth. So you'll have a lot of internal medicine patients, you have a lot of pediatric patients, etc. They come to the hospital for medical reasons, not for surgical reasons. Now, so this quarter 2 is usually characterized by higher occupancy but lower ARPOB. And if you look at Q3 is typically a weaker quarter. Year on year, you will find it to be a weaker quarter, which is this present quarter, because it is characterized by the festive season. A lot of the New Year, Christmas, holidays, etc. I think this is Diwali was also October. So you will see patients postponing their surgeries or doctors postponing the surgeries, etc. You do it by a few days or a few weeks or whatever. So typically Q3 is a weaker quarter. So you have, which is characterized by lower sort of occupancies. But you have higher ARPOBs in this season because whoever is coming for surgery is somebody who can't really put it off. So therefore, you're coming for more sort of acute and more quaternary care surgeries, etc., which typically will have a higher amount of billing. Also because Christmas, New Year's, a lot of international patients don't sort of come in, they postpone this thing because look, it's Christmas, New Year's also, etc. So the way to compare healthcare this thing is quarter compared to the previous quarter, previous year quarter, rather than sequentially the previous quarter because of the seasonality. Now Q4 is typically a stronger season, is the strongest sort of quarter in the year.
Okay. Yeah, fair enough. That's good. So last time this ARPOBs, we are already at 77-78%. Obviously, the concern remains, as last time you had highlighted, at peak you can go to 80-82%. And the bed additions, like you're trying to reconfigure or internalize. So 100 plus beds over the next 2 quarters. Where do you find comfort, and do you feel that before we materially add a higher number of beds, can we still manage to do 10 to 12% top line growth with the 77 or say 80% kind of occupancy levels?
No. So look, I think there are 2 or 3 separate things over here. Firstly, the number of beds we are coming out with over the next 6-7 months, I presume, is going to be 300 in Dwarka, 100 in Shalimar Bagh, and 100 plus that we are doing. So that's over 500 beds.
Okay.
That's one. Secondly, last quarter we were, this is quarter 2, we are at, I think, 78% occupancy. We've done months of 81, 82 also, and we've done quarters of 81, 82 as well. Some of our hospitals are operating at higher occupancies, and that's where, when you start in those hospitals where you start hitting occupancy thresholds, we also have that lever of payer mix, right? And you start accommodating your preferred channel at the cost of the unpreferred channel, and that's why we had guided that the unpreferred channel or the institutional business would come down accordingly. So there's enough leeway in the system to accommodate any sort of growth that we have, while the new capacity comes in. And I've only given you 500 beds, which is estimated to come in over the next 6 to 7 months. And then in 2025, we have more beds coming and so on.
Yeah, perfect. So lastly, versus the volume growth, so typically industry does around 8 to 10% volume growth. Any color on how the pricing trends are currently in the industry?
Year on year, you normally have a 2-2.5% impact on revenue as far as pricing is concerned.
Okay.
And that's pretty much across the industry, right? Yeah.
Yeah, fair enough. Yeah, that's all. Thanks.
Thank you. The next question is on the line of Lavanya Tutala from UBS. Please go ahead.
Hi, sir. Thanks for the opportunity. So I just wanted to understand how you look for break-even timelines for the greenfield project. I understand for the brownfield it's around 2 quarters. So for the greenfield project in Gurugram, how you look at the break-even timelines?
Yeah, so look, I think historically greenfields used to be about a 2-year sort of break-even. My belief is now it will be a 12 to 15 months sort of a break-even in greenfields.
Okay, got it. So, and the brownfield where the current occupancies are in the range of 75%, that should see somewhere like 3 quarters. High occupancy, something like 2 quarters, and greenfield 2 years. Is it the right way of looking, sir?
No, so we're not saying that. So, for example, you take the example of Shalimar Bagh. Now, quarter 3, the occupancy was 85% in that hospital, right? So, in a 85% occupancy, that means obviously means you are not admitting all the patients. So, at that point of time, when we open 100 beds, we think we should be able to, there should be a addition in the first quarter itself, right? So, we are not going to wait for 3 quarters for us to get some EBITDA from those additional 100 beds. So that should be immediate. Now, depends on where the occupancy is, but I would say probably not more than 3 to 4 months for EBITDA addition in a brownfield situation. Yeah?
I just got disconnected in the earlier commentary time. So if I understand right, 100 beds with the existing capacity and the Shalimar Bagh. So these 250 beds should be available for the full year FY24. And 300 beds from Dwarka should come in at what timeline, sir?
We said Q2 FY24.
Got it.
Second quarter, on or before September, yeah.
So around, for 2H it will be available, like the 300 beds of Dwarka.
That's right. Yeah.
Right, got it. And so on the acquisitions which you have highlighted, so what kind of assets you will be looking at, the standalone hospitals or a chain? I just wanted to understand your view on what kind of assets will you be looking if you are trying to enter a new region, or at least certain number of beds is the thing which you look at to consider an asset for this opportunity. So how you will be looking at it?
So the bigger the better. I mean, if you have a chain versus a single hospital, we prefer a larger sort of this thing. But it doesn't mean that we don't look at single hospitals. We look at that as well. What is important for us is that it has to be accretive to ROC. That we have, we can build. There is intrinsic value for us to unlock over that. Like I said, ultimately over the medium term, it needs to be value accretive and needs to be ROC accretive.
Okay, got it. Thank you. Thank you so much, sir. Thanks for the opportunity.
I mean, if I have to go to South India, I won't go with one hospital, but if I have to do it in adjacent to a cluster that we are, then we may do one hospital over there. So, I mean, I just won't buy one hospital, random hospital in, let's say, a 200 bed in Chennai. Or if I have to do Chennai, it has to be a larger sort of this thing. If I have to do Bangalore, it has to be a larger format. It just can't be a hospital for the sake of it and because we are acquiring some EBITDA or something like that.
Yeah, so this is helpful, sir. So that's what I wanted to check, if you would be looking for a certain Chennai or a place like where other chains are present. So that's what I wanted to check. This is helpful. Thank you so much.
Thank you.
Thank you. The next question is from the line of Krishnendu Saha from Quantum Mutual Fund. Please go ahead. Krishnendu Saha, your line is unmuted. Please go ahead with the question.
Can you hear me? Hello?
Yes.
Yeah. Sorry, this is the first time I'm on the company and I'm just taking everything on the fly. So maybe some of my data could be wrong. Just wondering, if I just do the divide by the revenue, the number of beds, is it coming to, like, revenue per bed is coming to around 6 million rupees? The reason I ask, hello, can you hear me?
Per bed.
Yes.
Yeah, 66,800 per OPD, per occupied bed day.
That's no, in the sense of what do you call that? That is RPOP you're talking about, right?
Yeah. RPOP is the revenue, yes.
Yes, but if I'm just the reason I'm asking is when I'm looking at you, you have a higher RPOP compared to a lot of other players, but your revenue, just if I just do a basic, so I'm just trying to understand what is actually giving this higher RPOP, and that's the basic question.
What's the question? Is the question why we have a higher ARPOB? Or you want to
let's just try to understand the business as to why we have a higher ARPOB. Is it because of a lot of foreign clients or because of the mix ratio? Just trying to get a feel of the business.
We have a higher clinical mix. Firstly, I think if you look at the two things which drive ARPOB, one is the payer mix, the other is clinical mix, right? As far as payer mix is concerned, 7.5% of our beds are totally free for the poor, compared to 1 or 2% for most of our competitors. If you look at 29% of our beds are catering to institutional business, compared to maybe 20 and 13% for some of our competitors, right?
I see.
So the payer mix is clearly inferior, but our ARPOB is maybe 20-25% better than the next best player in the industry. But more importantly, our EBITDA per bed is 55% better than the next best player in the industry.
Yes.
Okay. Now, EBITDA is better because on each and every, I think, line item, we outperform each of the hospitals that we compete in pretty much every micro market that we in. But as far as the revenue is concerned, we operate at a higher sort of more quaternary care, higher end of the clinical mix. So it's also indicated in the fact that we have more beds which are critical care beds. 35% of our beds are critical care beds. Most other people are between 25 and 30%. So it basically portrays that we are doing more high-end work as a proportion of the total work that we do. So it overcompensates for the lack of payer.
And with a higher occupancy also compared to the payers.
Yeah, occupancy has no role in the ARPOB, but I think the fact that we are present in the NCR, that also helps us, right? So NCR happens to...
And the stronger brand gives you higher occupancy. The occupancy is not a function of ARPOB or this thing. Occupancy is a function of your brand strength.
I see. And just just the expansion which we'll have, do you expect to maintain that 35% of the specialty types of of the revenue stream going ahead? Is it like because we'll be expanding at a faster click in the next 2-3 years? Just trying to get the feel that we will be able to maintain the 35% mix going ahead.
It will be higher, yeah. I mean, there's no reason for it not to be. We're looking at the same mix of business going into the future as well.
All right. In this sense, more on the understanding. Yeah, there's an available market which you can definitely address to. That's
available market. It's where the crunch is, right? I mean, if you look, 35% of our beds are critical care beds. Yet,
yes.
Where we don't have any beds available or the highest occupancy, if we look at in our system, is not in the ward beds, not in the rooms, etc. It's typically in the single rooms and more importantly in the ICUs, in the critical care. So as we are going forward, we are in fact intending to build more critical care beds.
Right.
Because that's where the bottleneck is in our current system. Yeah.
Okay. Thanks you. Thanks for the key.
Yeah.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good morning and congrats for a good set of numbers. I had just one question. As we bring this capacity to brownfield and some of these efficiencies, what is your thought in terms of being able to sustain or maybe improve the current payer mix and as well as sustain the current occupancy levels?
So, like I said, majority of the expansion is coming in our in brownfield, right? And the reason we are doing it, we're not doing it in order to tap the market. We are doing it because we've got unsatiated demand at our doorstep. So, I mean, the payer mix that we've got waiting of 6 hours to 2 days in a ER for the sort of bed that you may want. If you want an ICU bed or you want a single room, it's not available. I mean, go to Nanavati Hospital, you go to Max Saket, you go to Mohali, you go to hospital. That's where the challenge is. Go to places like Gurgaon and all, we don't have beds. Right? So there's no reason for that payer mix not to be sort of, to be any differentiation over there. Of course, we've guided in the past that our payer mix will be improving to a certain extent and then it will be plateauing out. It will be plateauing out because this new capacity is coming in by then.
So you think the current payer mix is very already plateaued out or you think there is still some improvement in the payer mix after which will plateau out, sir?
So we have guided that it should be down to 15% in the next 4-5 quarters.
Okay. And you remain confident on that number, sir?
That's right. You have to keep in mind, if you look at sequentially, in a weak quarter, you're going to be accommodative, right? I mean, a weak quarter in the sense that in a festive quarter where you have lower occupancy, okay, why would you want to have an idle bed? You're going to take more institutional or whatever else it at that point of time.
Yes.
Right? And this was a weak quarter. I mean, this is a seasonally weak quarter, not for us, but from occupancy standpoint.
Sure. And sir, any thoughts in terms of the revenue per operating bed? How do you see that? That should.
I think what needs to be looked at, okay, is the fact that in spite of it being a seasonably weak quarter, on an overall standpoint, right, we've navigated it to be the highest EBITDA quarter in margins, EBITDA per bed or absolute EBITDA in the history of the company.
Sure. And
right? So what happens in a stronger quarter?
Sure. So which would mean that even with this additional capacity coming in and with the leverage that we are talking of, actually we could see improvement in ARPOB, EBITDA per bed and EBITDA margins over the next few quarters.
No doubt on that front. I mean, I've repeatedly said that in the past that EBITDA per bed it will be accretive.
Sure. Great. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Ranveer Singh from Nuvama. Please go ahead. Ranveer, your line is unmuted. There's some background disturbance as well.
Yeah, thanks for taking my question. My question was, more about the macro situation here in healthcare or hospital industry. I see in this budget, the government has allocated some, I think, 6,000 to 7,000 crore for setting up AIMS in different locations. Just I wanted to understand going forward because government thrust has been to improve infrastructure, mostly in public sector. So do you see that public sector is emerging, strongly here, and that could give private sector a bit of competition in next 3-4 years? So how is your view on it?
I think anybody who's been to a public sector hospital should be able to answer that question. And even during COVID, when healthcare was, in focus and everybody was looking at it, you saw while there was no beds in private hospitals, okay, there were idle capacity, okay, in government hospitals across the board. So, I think if this public sector supersedes, then it probably, in my memory, will be the first time and first country where the public sector sort of outperformed the private sector. I don't think it's ever happened anywhere else. So I really don't see that coming as a threat. I think public sector hospitals are free hospitals. They are free to the poor and to the rich and everybody else. There is, when it is free, your idea is to provide healthcare coverage to more and more people, not necessarily the creature comforts there. So it's not as if your room has a TV over there, or you have an AC in the room, and so on and so forth. I mean, it's a very basic sort of this thing. I mean, you may not be aware, but most government, no government hospital even has a stream which is called critical care. I mean, ward size, the thing is Nightingale wards and so on and so forth. I think the whole push of the government is very, very different from that standpoint. I mean, after that, the next stage will be hospitals which are doing PMJY. We are not even doing PMJY. We don't even cater to that sort of, subset.
Okay, fine.
Yeah, I think for us, the hospital like AIIMS is basically a source of mental talent, right? So we typically, doctors working in AIIMS, after 20 years, they take voluntary retirement and they try and work in the private sector. So I think that, to us, is a good thing, right?
I mean, the massive, because the sort of range of skill sets that they develop in public hospitals is immense, simply because the volumes and the complexities they see over there. So typically you'll see a doctor having worked in any of the government hospitals, after a while leaves and joins the private sector.
Understood. Thanks for your view. And specific to company, just I missed a number that what was the contribution of international patient during this quarter in revenue?
9%.
And that what was in Q2? Same. Okay. And ARPO is normally much higher in international. So what would be the average ARPO of international patient?
Like I think Yogesh mentioned in the previous, this thing is 50% higher ARPO.
Okay, that's good. Thanks. That's all from my side. All the best.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. Good afternoon. Just trying to understand the margin outlook better for the next 4 to 6 quarters. I understand the bed additions of Shalimar Bagh, Dwarka, and the others you mentioned. They would have a little lower EBITDA per bed and the ARPOBs than the average. Would that understanding be correct, and would it have any impact on the margins?
Not in the brownfield hospitals, but Dwarka, yes, it will take time for Dwarka to start, generating EBITDA. So as Abhay mentioned, 12 to 15 months is when we see the break even in terms of EBITDA in Dwarka. That's a greenfield site. But other than that, it should be all better EBITDA per bed, etc., and better margin because these are all brownfield. As I mentioned, Shalimar 85% occupancy in quarter 3, right? So in that hospital, when I add 100 beds, you can understand how the occupancy they'll be updating the occupancy.
And the 100 plus beds which we are inking out of the present capacity, right? I mean, their EBITDA is again, you'll be swinging for the fences over there, literally with the EBITDA margins. So that 200 plus beds, 2 to 250 beds should give you a higher EBITDA, day one sort of thing. And Dwarka will take 12 months to sort of get there and thereafter.
Yeah, so but the 200 addition is higher than the average that the company is clocking, like 60.
Oh, yes, very much. No doubt about that. No doubt.
Okay, so on a blended basis, you are okay with the margin trajectory, or maybe see an improvement also?
That's right.
Okay, and how about M&A? I mean, clearly with the the fundraise plans and the cash, but I mean, we are sitting in Delhi NCR, which is the best micro market as such. But if we expand in the gaps, maybe in Mumbai or even even other tier 1 metros, this kind of ARPOBs are unheard of. So when we look into this M&A, would it be fair to see that we would be okay with the lower ARPOB to start with, and with case mix, etc., we would be improving? Or how should we think about it, in terms of M&A going into that particular micro market selection with respect to our margin stability and ARPOB stability?
So I think, Prakash, firstly, our highest ARPOB, our highest ROC businesses is not Delhi. Is the tier 2, tier 3 city. Okay. Secondly, my ARPOB in Mumbai is comparable, if not, higher than any of the Delhi hospitals.
Yeah, barring Mumbai, Delhi, we would be looking at M&A outside also, right?
So I'm saying outside Delhi and Mumbai. So like I said, even if I look at tier 2, tier 3 cities, my ROC over there is much higher than Delhi.
Yeah, understand ROC concept, but from the ARPOB and margin perspective, would we be open for lower ARPOB and lower margin business?
Of course. I'll be very open to lower. Only thing I'm concerned about is ROC. I'm okay with lower ARPOB. I'm okay with lower margins, so long as whatever in absolute terms is EBITDA per bed vis-a-vis what what we put in over there is accretive to us on a return on capital basis.
Understood. Okay. And just one more clarification. So during COVID times, there was a higher cash patient mix. So has that normalized now post-COVID? And how's the cash versus insurance? Insurance would have gone up, right?
Yeah, Prakash. So yes, insurance has gone up. After once the COVID set in, and there was more policy being sold, and that trend is continuing, right? So it's not that it was gone off and the share of insurance patients come down. It's been maintained at the same level now.
And cash would have gone down.
Yeah, it did. Yes.
And the differential, as per you, would be about what, 20% in pricing, 20-25%?
That's what is question? Pricing.
So in terms of insurance are obviously contracted rates. So that is about 20-25% lower in the cash patient billing, or
7%, 7 to 8%, 7 to 8%.
So that's it.
Yeah, and it actually works out better because when you have insurance policy, we get. And yes, there's been a step change in the frequency of people buying insurance, health insurance being more but this trend has been on for the last 10 odd years in some manner or the other. It works out well for the corporate hospitals because as and when you have insurance policy, you're paying the same amount of premium whether you go to Max or you go to ABC nursing home. And what we see is people don't window shop at that stage. You're less price sensitive, you go to the better brand, better hospital because eventually you pay the same premium.
Okay. Fair enough. Thank you so much.
Thank you.
Thank you.
The next question is from the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hi, thanks for taking my question. So the first one on the 100 beds that we are adding in our existing capacity, would that be more kind of the deluxe beds or the private rooms, etc., or would it be a mix of everything?
So it'll be more critical care beds and more single rooms, etc., because more of what we need.
Okay. So probably more ARPOB basically, if those gets filled, right? Because if it's single room, single room or deluxe room or critical care beds, etc.
It doesn't. We make more out of doing a liver transplant in a general ward than we do from doing a delivery in a suite.
Like, but over a longer period of time, that's not in your hand, right? Like over a longer period of time, the private room would be obviously a better, assuming that the mix over a long period across bed remains same.
That's right. So I would actually take the current mix and project it. It won't be lower than that because it's a general ward or whatever else it is. Okay. And like I said, most of our hospitals are suffering from bottleneck at the critical care.
And as per I believe that those critical care bed addition, etc., requires permission or something, right? So all those are in place for us?
Yeah. I mean, these are no permission required within the existing capacities.
Okay, great. And second, more of a longer term perspective, I believe that at one point you were saying that government would face challenges in terms of operationalizing this AIIMS kind of facility because of the cost overruns, etc. So has there been any talks between a player like Max and
I didn't get that. What are you referring to?
in terms of government being able to operationalize the AIIMS, etc., which they are kind of opening up now or investing in now, because their operational cost or operational cost structure is very different from private players, right? Maybe around the nursing expenses or nursing salaries around maybe 2.5 times than what they get in the private hospital. So at any point, is there any talks between government and player like you, to hand over the operations and management of such Apex Institute to a company like Max? Given we are also kind of, providing similar kind of care and...
No. It's a different profile and a different thing. I think, but what we are seeing is a lot of state governments, be it Haryana, be it UP, and so on and so forth, are inviting private players from, and they've been some RFPs and RFQs to that account for public-private partnerships, okay, on creating newer facilities. I mean, the government has its own way of working. You would have seen even the total outlay has been increased by about 13% towards the healthcare sector. So I'm sure the government will be able to, and whatever the economics of the government are the economics of the government facilities. Their viability, I'm not going to sit in question. The fact is, they are trying to cater to perhaps an audience which is an unaffordable audience, right? Which can't even afford PMJY sort of rates, etc. They, that's for free healthcare, effectively, and irrespective of viability. I don't think a private player is going to be catering to anybody who can't afford to pay at all.
Okay. Great. Yeah. Thank you.
Yeah.
Thank you. The next question is on the line of Sumit Gupta from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. Yeah, just I have a few questions regarding international patients. So just want to get a gist on the overall pricing. So I presume that international ARPOB is more than 1 lakh rupees. So it is gross or net of discounts and every other thing that you pay to the overall medical tourism agents and all?
So ARPOB is always gross, right? It's based on the revenue that you book, right? There may be some expense linked to that revenue, so we don't net that. That's coming this expense side.
No matter how you look at it, your EBITDA is 20% higher, like what you just said, right, per bed.
Okay. And one more thing regarding sequentially, if I see that payer mix for international patient, it is nearly like 9%, so consistently. But so going forward, do you see it at 9% or like moving into 10-11% also with like new geographies opening up?
So that, our focus is always on the occupied bed days increasing, right? I mean, if it remains 9 and other businesses also increasing, so so be it, right? So long as the operating bed days are on an absolute or a standalone basis for medical is increasing. So we don't necessarily look at it as a percentage of the overall pie. We look at it as a separate segment altogether. So we look at, is international number of bed days occupancy increasing or not? Is the total revenue in absolute terms increasing or not? And then separately, we look at the same way for upcountry business. We look at the same way for cash business. We look at it the same way for other businesses, right?
Right.
Not so much. My focus or our focus is on this thing. Now, 9% being flat on 2 quarters also because, just like I said, it's a seasonality. People don't travel during the festive season. Doctors themselves put off surgeries, etc., because they're on holidays.
Sure. Thank you, sir.
I mean, the better way to look at it is same time last year. Unfortunately, last year being a little bit of a COVID year, you have uneven comparison. But then you will, we all forced to look at pre-COVID levels. But sequentially, one should avoid. You will typically see the first quarter and the third quarter are weak quarters. And for these very reasons, they're weak.
Okay. Okay. Thank you, sir.
Thank you. The next question is from the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Yeah, hi, sir. Just one small question to maybe Yogesh, sir. Like, can you help me with the tax rate for maybe how do we look at it going forward? Maybe FY24?
So tax rate, I said this earlier also, it should be in the ETR should be in the range of 18 to 20%, right? So this quarter was 18 plus.
Okay.
Right? But I would say it will peak at 20 on the network basis. But you will note that this quarter the CTR has come down. The current tax rate has come down. It's by virtue of the fact that last quarter we did some voluntary liquidation and there are some incident benefit of that liquidation in terms of depreciation or intangible. So I would say two things. One, that the rate would be 18-20%. Secondly, I would say watch out the CTR rate. That's better because that's where the cash outflows are linked to, right? And that's improved over the quarter one and quarter two.
Okay. Yeah. So 18 would be a fair assumption to consider 18 somewhere between 18 to 20.
I would say go towards the higher range of 18 to 20.
Okay, fair enough. Thanks. I'm done.
Thank you. Next question, follow-up question from the line of Ashish Thavkar from IIFL AMC. Please go ahead.
Yeah, thanks for the opportunity again. So if given an opportunity, would you also like to consider standalone hospitals which are very specialized in, say, oncology or child healthcare?
Sorry, can you repeat the question?
Yeah, so if you get an opportunity in future, would you also be willing to consider standalone hospitals which are specialized in oncology, pure play oncology, or say something like pure play childcare?
We'll evaluate everything. I mean, I have no issues evaluating anything.
Okay.
When the opportunity arises, we will evaluate.
Okay, helps. So lastly on this app-based model, if you could just give some color on the potential of this model, and would there also be a cash burn?
Sorry, on which model exactly?
On the app-based model, how you are planning to position yourself through the app, the digital one?
Oh, on the app?
Yeah.
So there's no cash burn. We are not doing agnostic this thing. It's not a platform. This is it is a platform for our patients to interact with our doctors and our doctors to interact with our patients, and for the hospital to provide services to the patients, right? Be it diagnostics at home or home care business or video consults and so on and so forth. I mean, I encourage you to actually look at the app. Please download it and look at it. So I think all your reports, everything is sort of stored over there. So it's effectively a platform between the hospital and the patients, okay, to interact, and for us to deliver those services to the patients.
Okay, perfect. That was it, sir.
For third-party players, etc. So I mean, it's very, very different. I mean, it's not 24/7 or anything like that. I mean, it is 24/7, but it's for us. So we're not marketing it as a third-party platform. I mean, the cash burn itself in it is essentially what it is for technology and a little bit of marketing that we will be doing, within the Delhi NCR or whatever reasons through the hospitals, etc. So I'm not looking at any significant cash burn or anything which will even move the needle over here.
Okay. And would your diagnostic offerings would also be clubbed with this app?
No, absolutely. So we will be providing diagnostics through the app as well.
Okay, sounds good. Thank you. And
okay, so on our app, at the top, okay, there's a red button which can get you an ambulance in Delhi anywhere, anytime within 20 minutes. That's one, which will take you to a Max hospital. Then diagnostics, then nurses, then all your medical records, then any video consults that you want, any scheduling of appointments that you may want to do, and so on. Yeah. Physiotherapy at home, anything. So anything so the entire suite of services that a hospital provides can be provided to you at your doorstep, effectively, or without you entering the hospital premises. That's what the app does.
And it will also review trends of your diagnostic, etc., reports. So in a way, it's there to improve the experience. It's there to improve the interaction of the patient with the hospital and vice versa. And ease these,
But check it out, it's out there. I think that's the most important thing.
Yeah, sure. I will. Yeah. Thanks, sir. This is helpful and all the best.
Thank you. Thank you.
Thank you. So the next question is a follow-up question from Krishnendu Saha from Quantum Mutual Fund. Please go ahead.
Yeah, just thanks for the question again. Just clarifying, our average length of stay at 4.2 is there higher, or it probably could go down a little bit more? Just trying to understand, is high because of the critical care being a larger portion, is it? And can it go down further?
And higher services. And eventually you need to look at average revenue per occupied bed. Because
yes.
Your inventory in hand effectively is number of bed days that you have. So if a higher ALOS but which leads to a higher ARPOB works for you, that's because you're doing more higher end. So look, if a place has more medical patients, this thing is lower. But if you have more transplant patients, it's longer. But a transplant patient will pay you more. The more BMT transplant, lung transplants, heart transplants you do, people tend to stay longer. And the billing is more, the ARPOB is more, the length of stay is more. So you can't really compare a particular hospital chain with B and C.
Yeah, so some matrix which you look at ALOS and all these days and occupancy and all. So we're just trying to figure out as to why, because we have a little bit higher ALOS. So that's why.
You can't compare. That's what I'm saying. Huh?
Yeah.
Within my chain, I can't compare two hospitals because they may be leading to different medical programs. I have to necessarily compare programs to programs, or I have to compare the same hospital to its absolute this thing in the previous year.
It will actually be a procedure to procedure, right? So that's how you can compare ALOS.
Yes.
But I think the average revenue per occupied bed is the better metrics, because that will have ALOS play into it already, right? So
yes.
Yeah, so I think that if that metric is growing and is better than others, that to my mind that means ALOS should not be even looked at it.
Yeah. Thank you.
Yeah.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
So thank you. I appreciate everybody coming online. And I just want to reiterate that, we are the two pillars of the foundation that our organization rests on are execution. So we are very, very focused on execution, not only in operations, but on projects as well, to see that they are rolled out in time. And secondly is fiscal discipline. So you would see that any leverage at all we use for inorganic growth, we would be within what are declared norms or prudent norms for leveraging the company AR, which are not more than 2.5 times EV to EBITDA. So thank you for the opportunity. Goodbye.
Thank you very much. Ladies and gentlemen, on behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.